Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing IBM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. IBM manufactures and sells computer hardware, middleware, and software. It also provides hosting and consulting services in areas ranging from mainframe computers to nanotechnology. They are a major research organization holding the record for most annual US patents generated by a business for 28 consecutive years. Inventions by IBM include the automated teller machine, also known as the ATM, floppy disk, hard disk drive, magnetic stripe card, relational database, SQL programming language, UPC barcode, dynamic random access memory, and the list goes on and on. The company is headquartered in Armonk, New York, and was founded in 1911. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Zicha, Vienna, EuroTLX, Swiss, Sao Paulo, Buenos Aires, Bulgaria, Santiago, Brussels, and Kazakhstan. Let's get started with the model. This is a large cap company, 124 billion market cap. They're trading at 138 a share, and they have 896 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. That number peaked in 2020 at 15 billion. It's down to 8.7 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was high in 2019 at 9.4 billion. It's down to 5.5 billion in the trailing 12 months. Revenue is a sales for the company, and that doesn't look so good. It goes from 77 billion down to 54 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was lowest in the trailing 12 months at 31 billion. But it looks like as a percent of revenue, it's the highest in the trailing 12 months. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue, such as R&D. Gross profit minus operating expenses gives you your operating income, and that was almost as high as 2020 and 2021 with lower revenue. They do have a lot of debt, this company. They pay 1.2 billion of interest on their debt, which is lower than 2019 and 2020, a bit higher than 2021. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example of this is an asset impairment. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income. And they do have pretty healthy net income each year. The number has stayed pretty steady since 2020. Here's the company's most recent income statement they released a few days ago. Revenue in the first quarter is 14.2 billion, up 1 billion from the same time period last year. Software is leading the way at 5.8 billion, consulting 4.8 billion, infrastructure 3.2 billion. Infrastructure is pretty flat from last year, but software and consulting are up quite a bit. Their gross margins in 2022 were 52%, last year was 53%. They have really good margins in software, which makes sense, that's 80%. Consulting is only 24% because that requires a lot of manpower. Infrastructure 50% and financing 38%. They spend 4.6 billion in SG&A. This includes payroll for support functions and also marketing. Research and development 1.7 billion. So their net income is down from 950 million to 730 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They generated over 11 billion of cash flow in the trailing 12 months. But that is lower than prior years. It was over 18 billion in 2020. They spend a good amount in CapEx since they do manufacturing. Operating cash flow minus CapEx gives you your free cash flow. And they do have lots of free cash flow remaining. It was lowest in the trailing 12 months at 8.7 billion, but that's still a lot of cash to work with. That's why they do pay a pretty good dividend. and they paid down $8 billion of debt in 2021. They paid down about $3 billion of debt. But in 2019, they added $20 billion of debt. And you could see that was due to an acquisition in 2019, because they spent $27 billion in investing cash flow. And they usually buy back stock most years. They bought back $1.6 billion in 2019, $300 million and $300 million. Every time a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. This is their most recent statement of cash flows for the first quarter of 2022 versus the first quarter of 2021. They generated $3.2 billion of operating cash flow in the first quarter. That is a lot less than last year of $4.9 billion. They spent $1.4 billion of investing cash flow. Last year was $2 billion. They do spend a lot of money in acquisitions, $700 million this year. Last year was $1.1 billion. In the first quarter, they added $3 billion of debt, paid out $1.5 billion of dividends. Last year, they paid down $4 billion of debt and paid a similar amount of dividends. So in their financing section, they had a cash inflow of $1.4 billion. Last year was a cash outflow of $6 billion. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And they do generate a lot of revenue, and you can see it's on a slight decline over the past 6 years. Hopefully they can reverse that trend going forward. And they do generate a pretty consistent, healthy amount of operating cash flow each year. This is the equity section on their 331 balance sheet. They have $19 billion of equity. They raised $58 billion from selling common stock. They profited $153 billion from running their business. And for the past 2 decades, lots of companies have been buying back stock. They bought back $169 billion of their own stock. This removes that stock off the open market, which makes the stock price higher. It makes your ratios better, like your earnings per share. But if they really needed money, they can just reissue this stock. Let's look at the capital structure. They have $19 billion of equity, $58 billion of debt. They're 25% equity, 75% debt, so they're pretty leveraged. This is their capital structure since 2015, so you can see they've always been pretty leveraged. Their debt has been a lot higher than their equity. That's not ideal. But as long as they continue bringing in cash flow and paying a dividend, I think most investors are happy. I gave them the highest whack on Finbox, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $232 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $152 billion. We divide that by 900 million shares. And we get a calculated stock price of $169. They're trading at $138, so they're trading at an 18% discount. It's a buy according to the model. I'm going to try something different in my models. To calculate the value of the company, I'm summing the present value of their future free cash flows, and then I'm going to minus their debt. Because I'd rather be conservative than too aggressive. And I'm going to see how this works out in my model if that seems to be more in line with the market. Because if I did not strip out the debt, their valuation would be so high. And every company's unique, so not every single model is going to work the same for every single company. Sometimes you have to tweak it a little bit, especially for companies that aren't generating positive cash flow. Their 2024 revenue is expected to be $66.1 billion. In 2023, $63.2 billion, 2022, $61 billion. Then I just continued that trend into 2025. That's how I got $69 billion. They convert on average 17% of their revenue into free cash flow. So I multiplied their future revenue estimates by 17%. That's how I got their future free cash flows. The website Simply Wall Street values the company at 177. They're saying it's 21% undervalued. 13 analysts priced this stock and the average price target is 145. The low is 115. The high is 166. This is where the stock has been trading the last 5 years. It was over $160 in the beginning of 2018. Then it dropped down to about $80 when COVID hit. And it has come up about 60-70% since that bottom. But if you bought it before 2020, there's a good chance you paid over $140. So you'd be down right now. Here's a comparison to IBM the last 5 years against the S&P 500 and a couple of competitors. IBM is doing the worst, down 17%. HP is up 14%. The S&P is up 85%, and Accenture is up 166%. And this doesn't include the dividends. If you build in the quarterly dividends and compound that, then IBM is probably not down. They're probably close to break even. They do pay a generous and consistent dividend each year. It was 143 in 2017, it's up to 164. Their yield is 4.75%. To calculate the yield, you can multiply the last dividend payment by 4, take that number and divide by the stock price. And they pay out 68% of their free cash flow, over 100% of their net income. The forecast is for their yield to stay high. The projection is for it to hit 5.2% by the end of 2024. Even though the stock price hasn't been doing that well the past few years, their dividend is improving. Their beta is close to 1, so the stock moves with the market. It's gone up 3% in the past 52 weeks, while the S&P is up 5%. The 52-week low is 115, the high is 146. And the stock is on an uptick, trading above its 50-day and 200-day moving average. 5 to 6 million shares are traded each day on this stock. Pretty much all the shares outstanding are on float, 57% are held by institutions, and 2.4% of the shares are shorted. They've done 5 stock splits in their history, a 5-for-4 in 73, a 4-for-1 in 79, a 2-for-1 in 97, a 2-for-1 in 99, and almost a 1-for-1 in 2021. Not sure why they did this. Let me know in the comments if you know why. I could understand a 3-for-2 stock split or a 5-for-4, but I don't understand why companies do this. Their employee count has been decreasing over the years. It was about 380,000 in 2016, and they lost about 100,000 employees since then. That's not something you want to see when investing in a company. The CEO of the company's salary is $1.5 million in 2021, and their compensation package is close to $18 million. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be pretty much flat today. The only insider activity I found was Michelle Howard. She bought 80 shares back in December, so she's up a little bit on this investment. 57% of the company is held by institutions, 43% by the general public, and a small amount by insiders. Vanguard is the biggest shareholder, 8.4%, 76 million shares valued at almost $11 billion. Then BlackRock, State Street, Schwab, and Geode. Let's look at their financial ratios. Their PE is pretty close to the market average. That's stock price over earnings per share, 22.4. A good price to sales of 2.3, stock price over sales per share. Their price to book is 6.5, that's stock price over book value per share. The way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet. Their tangible equity is negative $50 billion, since they have so many intangibles from all the acquisitions they do. Their price to free cash flow is 14.3, that's stock price over free cash flow per share. Let's look at their non-current assets, 5.6 billion of PP&E. The value of the assets they lease are 3.1 billion. Their customers owe them 4.6 billion. This is owed to them beyond 12 months. And we know this because it's in the non-current asset section. If it was in the current asset section, it would be owed within 12 months. They have 10 billion of pension assets for the employees. They have a deferred expense of 916 million. This is an expense they have incurred, but they haven't paid it yet. 7.6 billion of deferred taxes. This should help reduce their taxes in the future. 56 billion of goodwill. This is why their tangible equity is negative. Goodwill is the premium you pay when you acquire another company. 12.3 billion of other intangible assets. And 1.8 billion of investments. Let's look at their non-current liabilities. 47 billion of debt. They owe 14 billion of retirement benefits to their employees. 3.4 billion of deferred income. This is when a customer prepays for a product or service that the company will deliver in the future. They owe 2.3 billion on their operating leases and 14 billion of other. Their return on invested capital is 7.8%. The way you calculate that, you take their operating income times 1 minus the tax rate. Then you divide that number by their equity plus their net debt. Net debt is their debt minus their cash balance. They can cover the interest payments on their debt 5.5 times. So even though they have lots of debt, they can cover the expenses. They have a really high ROE of 29%, that's net income over equity. Their current ratio and quick ratio are slightly below 1. Current ratio is current assets over current liabilities. Let's look at their current assets. They have $10 billion of cash, $286 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose, like for example, to purchase a factory. $550 million of marketable securities. These are usually highly liquid, low-risk investments. They have $6 billion of accounts receivables. This is how much money their customers owe them over the next 12 months. They're also owed another $7.2 billion in short-term financing and another $1 billion of other receivables. They have $1.8 billion of inventory, $1.1 billion of deferred expenses, and $3.5 billion of prepaid expenses. Prepaid expenses is similar to deferred costs. Let's look at their current liabilities. They owe the government $1.8 billion of taxes. They have $7.7 billion of debt. They owe their vendors $3.5 billion. They receive prepayments from their customers of $13.5 billion. So when they deliver the product or provide the service, then they'll remove some of this dollar amount off their balance sheet and book it as income onto the income statement. They owe $954 million on their leases over the next 12 months and $6.6 billion of other. They generated $8.7 billion of free cash flow in the trailing 12 months, and they have negative $2.7 billion of working capital. Plus, they pay out nearly $6 billion in dividend payments. So it looks like they're going to be pretty tight. In order to get a larger buffer, they need to generate more free cash flow or possibly take on some more debt, or alternatively cut their dividend, which is unlikely. The best way to look at ratios is to compare them to companies in the same industry. There are 81 companies in the same industry as IBM, and IBM is the second largest in terms of market cap. Only Accenture is larger. They spend the most in CapEx of all the companies. They have a terrible debt to equity ratio, much worse than average. They do pay the highest dividend of all the companies. They generate lots of free cash flow, a lot more than Accenture. Their price to book is worse than average, but their PE and price to free cash flow and price to sales are much better than average. They generate lots of revenue, but their revenue has been declining over the past 3 years. They have a good ROA of 4%, that's net income over assets. It's how well you use your assets to generate a profit. And an even better ROE at 29%. That's how well you use your equity to generate a profit. So to summarize, I have them trading at an 18% discount, and IBM is not the company it used to be. There's just so much more competition now, but they're still a pretty solid company. I don't think there's too much risk in holding the company long term, but it doesn't seem like there's that much upside. But I'm pretty confident they're never going to cut their dividends. You're going to always get that consistent payment. I rank their free cash flow 6 out of 10, their revenue 6 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.